हेलो दोस्तों, बिगनर्स पॉइंट में आपका स्वागत है। और अभी हम कर रहे हैं इकोनॉमी। ठीक है। बेसिक नेशनल एग्री इनकम एग्रीगेट्स, ग्रॉस डोमेस्टिक प्रोडक्ट एट मार्केट प्राइस, जीडीपी एमपी. GDP is the market value of all final goods and services produced within a domestic territory of a country measured in a year. All production done by the national residents or the non-residents in a country gets included regardless of whether that production is owned by a local company or a foreign entity. Everything is valued at market prices. GDP MP equals to C plus I plus G plus X minus M. GDP at factor cost, GDP FC. GDP at factor cost is gross domestic product at market prices less net product taxes. Market prices are the prices as paid by the consumer. Market price also include product tax and subsidies. The term factor cost refers to the prices of products as received by the producers. Thus, factor cost is equal to market prices minus net indirect taxes. GDP at factor cost measures money value of output produced by the firms within the domestic boundaries of a country in a year. GDP FC equals to GDP MP minus NIT. Net domestic product at market price, NDP-MP. This measure also policymakers to estimate how much the country has to spend just to maintain their current GDP. If the country is not able to replace the capital stock lost through depreciation, then GDP will fail. NDP-MP equals to GDP-MP minus depreciation. ये इन सब के फॉर्मूले हैं. NDP at factor cost, NDP-FC. NDP at factor cost is the income earned by the factors in the form of wages, profits, rent, interest, etc. within the domestic territory of the country. NDFC equals to NDP MP minus net product taxes minus net production taxes. Gross national product at market prices, GNPMP. GNPMP is the value of all the final goods and services that are produced by the normal residents of India and is measured at the market prices in a year. GNP refers to all the economic output produced by a nation's normal residents, whether they are located within the national boundary or abroad. Everything is valued at the market prices. GNP MP equals to GDP MP plus NFIA. GNP at factor cost, GNP FC equals to GNP at factor cost measures value of output received by the factors of production belonging to a country in a year. GNP-FC equals to GNP-MP minus net product taxes minus net production taxes. Net national product at market prices, NNP-MP. This is a measure of how much a country can consume in a given period of time. NNP measures output regardless of where that production has taken place in domestic territory of or abroad. NNP-MP equals to GNP-MP minus depreciation. NNP-MP equals to NDP-MP plus NFIA. NNP at factor cost, NNP-FC. NNP at factor cost is the sum of income earned by all factors in the production in the form of wages, profits, rent, and interest, etc., belonging to a country during a year. It is the national product and is not bound by production in the national boundaries. It is the net domestic factor income added with the net factor income from abroad. NI यानी कि नेशनल इनकम इक्वल्स टू NNP-MP माइनस नेट प्रोडक्ट टैक्सेस माइनस नेट प्रोडक्शन टैक्स इक्वल्स टू NDP-FC plus NFIA equals to NNP-FC. GVA at market prices, GDP at market prices, GVA at basic prices, GVA MP minus net product taxes, GVA at factor cost, GVA at basic prices minus net production tax. Nominal and real GDP. One implicit assumption in all this discussion is that the prices of goods price of goods and services do not change during the period of our study. If price change, then there may be difficulties in comparing GDPs. If we measure the GDP of a country in 2 consecutive years and see that the figure for GDP of the latter year is twice that of the previous year, we may conclude that the volume of production of the country has doubled, but it is possible that only prices of all goods and services have doubled between the 2 years, whereas the production has remained constant. Therefore, in order to compare the GDP figures and other macroeconomic variables of different countries, or to compare the GDP figures of the same country at different points of time, we cannot rely on GDPs evaluated at current market prices. For comparison, we take the help of real GDP. Real GDP is calculated in a way such that the goods and services are evaluated at some constant set of prices or constant prices. Since these prices remains fixed, if the real GDP changes, we can be sure that it is the volume of production which is undergoing changes. Nominal GDP, on the other hand, is simply the value of GDP at the current prevailing prices. For example, suppose a country only produced bread. अगर हम मानते हैं खाली क्या ब्रेड कर रही है, प्रोड्यूस क्या कर रही है, ब्रेड. In the year 200, it had produced 100 units of bread. Price was 10 per unit per bread. कितनी यूनिट करी है, 100 यूनिट्स, और प्राइस कितनी है एक ब्रेड की, 10 रुपये. GDP एट करेंट प्राइस वॉज 1000. तो GDP कितनी हो जाएगी, 100 × 10 = 1000, यानी कि 1000. In 2001, the same country produced 110 units of bread at price 15 per bread. Therefore, nominal GDP in 2001 was rupees 16 1650. Real GDP in 2001 calculated at price of year 200. 200 will be called the base year, will be 110 into 10 = 110. Notice that the ratio of nominal GDP to real GDP gives us an idea of how the prices have moved from the base year, the year whose prices are being used to calculate the real GDP, to the current year. In the calculation of real and nominal GDP of the current year, the volume of production is fixed. Therefore, if these measures differ, it is only due to change in the price level between the base year and the current year. The ratio of nominal to real GDP is a well-known index of prices. This is called GDP defaulter. Thus, if GDP stands for nominal GDP and GDP stands for real GDP, then GDP defaulter GDP बटे GDP. Sometimes the defaulter is also denoted in percentage terms. In such a case, defaulter GDP divided by GDP into 100%. In the previous example, the GDP defaulter is 1650 divided by 1100 equals to 1.50. In percentage terms, this is 150%. This implies that the price of bread produced in 2001 was 1.5 times the price of 2000. जो प्राइस 2000 में था उससे 2001 में 1.5 टाइम्स बढ़ गया है, यानी कि 1.5 गुना ज़्यादा हो गया है. Which is true because price of bread has indeed gone up from rupees 10 to 15. Like GDP defaulter, we can have GNP defaulter as well. There is another way to measure change of prices in an economy, which is known as the Consumer Price Index (CPI). This is the index of prices of a given basket of commodities which are bought by the representative consumer. CPI is generally expressed in percentage terms. We have 2 years under consideration. One is base year, the other is current year. We calculate the cost of purchase of a given basket of commodities in the base year. We also calculate the cost of purchase of the same basket in the current year. Then we express the latter as a percentage of the former. This gives us the consumer price index of the current year with the base year. For example, let us take an economy which produced two goods, rice and cloth. a representative consumer buys 90 kg of rice and 5 piece of cloth in a year. अब हमने अनदर एग्जांपल लिया है. उस एग्जांपल में क्या है, एक राइस है और एक क्या है, क्लोथ है. राइस हमने 90 केजी लिया है और इसके कपड़े 5 पीस लिए हैं. सपोज इन द year 2000 the price of a kg of rice was rupees 10 and a piece of cloth was rupees 100. So the consumer had to spend a total sum of 10 into 90 equals to 900 on rice in 2000. Similarly, she spent rupees 100 into 5 equals to 500 per year on cloth. Summation of the two items is 900 plus 500 equals to 1400. Now suppose the price of a kg of rice and a piece of cloth has gone up to rupees 15 and 120 in the year 2005. To buy the same quantity of rice and clothes, the representative will have to spend rupees 1350 and 600 respectively, calculated in a similar way as before. Their sum will be rupees 1350 plus 600 equals to 1950. The CPI therefore will be 1950 divided by 1400 into 100, 139.29 approximately. It is worth noting that many commodities have two sets of piece. One is the retail price, which the consumer actually pays. The other is the wholesale price, the price at which goods are traded in bulk. These two may differ in value because of the margin kept by traders. Goods which are traded in bulk, such as raw materials or semi-finished goods, are not purchased by ordinary consumers. Like CPI, the index for wholesale prices is called Wholesale Price Index (WPI). In countries like USA, it is referred to as Producer Price Index (PPI). Notice CPI and analogously, WPI may differ from GDP defaulter because the goods purchased by consumers do not represent all the goods which are produced in a country. GDP defaulter takes into account all such goods and services. CPI includes price of goods consumed by the representative consumer, hence it includes prices of imported goods. GDP defaulter does not include prices of imported goods. The weights are constant in CPI, but they differ according to production level of each good in GDP defaulter. GDP and welfare. Can the GDP of a country be taken as an index of the welfare of the people of that country? If a person has more income, he or she can buy more goods and services, and his or her material well being improves. So it may seem reasonable to treat his or her income level as his or her level of well-being. GDP is the sum total of value of goods and services created within the geographical boundary of a country in a particular year. It gets distributed among the people as incomes, except for retained earnings. So we may be tempted to treat higher level of GDP of a country as an index of greater well-being of the people of that country. To account for price changes, we may take the value of real GDP instead of nominal GDP, but there are at least three reasons why this may not be correct. Distribution of GDP minus how uniform is it? If the GDP of the country is rising, the welfare may not rise as a consequence. This is because the rise in GDP may be concentrated in the hands of very few individuals or firms. For the rest, the income may in fact have fallen. In such a case, the welfare of the entire country cannot be said to have increased. For example, suppose in year 2000, an imaginary country had 100 individuals each earning 10 rupees. इमेजनरी कंट्री मतलब मान लो कि 2000 में कितने 100 इंडिविजुअल्स लोग रहते हैं और हर कोई 10 रुपये कमाता है. देयरफॉर द जीडीपी ऑफ द कंट्री वाज 1000. कितनी हो जाएगी जीडीपी? 1000 बाय इनकम मेथड के हिसाब से. इन 2001 लेट अस सपोज द सेम कंट्री हैड 90 इंडिविजुअल्स, उसी कंट्री में 2001 में कितने बचते हैं? 90, जो कि 9 रुपये कमाते हैं, यानी कि 9 रुपीज़ पर ईच कमाते हैं। अर्निंग्स अर्न करते हैं 90, जितने भी लोग रहते हैं 90, वो 9 रुपीज़ अर्न करते हैं। एंड द रेस्ट 10 इंडिविजुअल्स अर्निंग 20 रुपीज़, 20 रुपीज़ अर्न करते हैं 10। 90 कमाते हैं 9, 10 कमाते हैं 20। सपोज देयर हैड been no change in the prices of goods and services between these two periods. The GDP of the country in the year 2001 was 90 into 9 plus 10 into 20 equals to 810 plus 200 equals to 1010. Observe that, अगर इसको हम ऑब्जर्व करें तो हम पाएंगे कंपेयर टू 2000 द जीडीपी ऑफ द कंट्री इन 2001 वाज हायर बाय द 10 रुपीज़। कितनी है? 10 रुपये ज़्यादा है। बट दिस हैज़ हैपन्ड व्हेन 90% of people of the country have seen a drop in their real income by 10% from 10 to 9, whereas only 10% have benefited by a rise in their income by 100% from 10 to 20. 90% of the people are worse off through the GDP of the country has gone up. If we relate welfare improvement in the country to the percentage of people who are better off, then surely GDP is not a good index. Non-monetary exchanges. Many activities in an economy are not evaluated in monetary terms. For example, the domestic services women perform at home are not paid for. The exchanges which take place in the informal sector without the help of money are called barter exchanges. In barter exchange, goods or services are directly exchanged against each other. But since money is not being used here, these exchanges are not registered as part of economic activity in developing countries where many remote regions are underdeveloped. These kinds of exchanges do take place, but they are generally not counted in the GDPs of these countries. This is a case of underestimation of GDP. Hence, GDP calculated in the standard manner may not give us a clear indication of the productive activity and well-being of the country. Externalities refer to the benefits of harms a firm or an individual causes to another for which they are not paid or penalized. Externalities do not have any market in which they can be bought and sold. For example, let us suppose there is an oil refinery which refines crude petroleum and sell it in the market. The output of the refinery is the amount of oil it refines. We can estimate the value added of the refinery by deducting the value of intermediate goods used by the refinery, crude oil in the case, from the value of its output. The value added of the refinery will be counted as part of the GDP of the economy. But in carrying out the production, the refinery may also be polluting the nearby river. This may cause harm to the people who use the water of the river, hence their well-being will fall. Pollution may also kill fish or other organisms or of the river on which fish survive. As a result, the fishermen of the river may be losing their livelihood. Such harmful effects that the refinery is inflicting on others, for which it will not bear any cost, are called externalities. In this case, the GDP is not taking into account such negative externalities. Therefore, if we take GDP as a measure of welfare of the economy, we shall be overestimating the actual welfare. This was an example of negative externality. There can be cases of positive externalities as well. In such cases, GDP will underestimate the actual welfare of the country. अब आ जाते हैं इसकी समरी पर. At a very fundamental level, the macroeconomic economy, it refers to an economy that we study in macroeconomics, can be seen as working in the circular way. The firms employ inputs supplied by households and produce goods and services to be sold to households. Households get the remuneration from the firms for the services rendered by them and by goods and services produced by the firms. So we can calculate the aggregate value of goods and services produced in the economy by any of the three methods: measuring the aggregate value of factor payments income method, measuring the aggregate value of goods and services produced by the firm's product method, measuring the aggregate value of spending received by the firm's expenditure method. In the product method, to avoid double counting, we need to deduct the value of intermediate goods and take into account only the aggregate value of final goods and services. We derive the formula for calculating the aggregate income of an economy by each of these methods. We also take note that goods can also be bought for making investments, and these add to the productive capacity of the investing firms. There may be different categories of aggregate income depending on whom these are occurring to. We have pointed out the difference between GDP, GNP, NNP at market price, NNP at factor cost, PI and PDI. Since prices of goods and services may vary, we have discussed how to calculate the three important prices in indices: GDP defaulter, CPI, WPI. Finally, we have noted that it may be incorrect to treat GDP as an index of the welfare of the country. ठीक है, और इसी के साथ ये चैप्टर हो जाता है ख़त्म। अब मिलेंगे अगले चैप्टर में।